Richard Dennis stood out in trading history, not just because of the money he made, but because of the belief he carried about what defined success in the markets. Most traders at the time believed you had to be born with an instinct for reading price action, some innate talent that could not be taught. Dennis challenged that very notion. He believed that trading was not about natural gifts, but about systems, discipline, and following rules with precision. This belief became the foundation for one of the most important lessons in trading mindset. Your destiny as a trader is not locked in your DNA. It is shaped by what you choose to believe and how you act on that belief. At the time, Dennis was already a millionaire by his late 20s, known as the Prince of the Pit in the Chicago commodities markets. He had started with just a few $100s and turned it into hundreds of millions. To many, that journey seemed mythical, as if it required a sixth sense that could never be duplicated. Yet, Dennis didn't accept that. He insisted that his success wasn't due to extraordinary intuition, but to a repeatable, structured approach to trading. This is where belief shaped not only his career, but the careers of those he would later mentor. The way belief operates in trading is subtle but profound. If you believe markets are chaotic and impossible to master, you will approach them with hesitation, inconsistency, and fear. Your actions will reflect your disbelief, leading to mistakes and reactive decisions. On the other hand, if you believe that the markets can be understood through rules and probabilities, you will approach them with structure, confidence, and calm. Dennis believed deeply in this second path. He trusted systems over impulses, and that belief became the driver of his success. This belief was put to the test when Dennis entered into a friendly debate with his partner, William Eckhart. Eckhart argued that trading could not simply be taught, that successful traders had something unique in their wiring. Dennis disagreed passionately. He was convinced that anyone with discipline and the right mindset could become a profitable trader if given a system and the will to follow it. From this debate, the famous turtle experiment was born, but the experiment itself only came after years of Dennis living out his belief in his own career. He consistently proved that rigid adherence to his rules led to outsized gains. He demonstrated that conviction in a process matters more than conviction in a single trade. For Dennis, it wasn't about being right all the time. It was about trusting the system through wins and losses. Belief in his world wasn't blind hope. It was confidence, anchored in tested methods, and a willingness to see those methods through, regardless of short-term noise. For traders, this mindset is critical. Every time you enter a position, there is uncertainty. Prices can move against you quickly, and the temptation to abandon your plan grows stronger with every tick in the wrong direction. Without belief in your system, you will cut winners too early or hold losers too long. You will second-guess yourself until your account reflects the cost of that hesitation. Belief is the glue that holds discipline together. Richard Dennis understood this and lived it daily. He framed his career around the idea that if you trust the process more than the emotions, your outcomes will compound in your favor. Belief also shaped the way Dennis viewed failure. To him, a losing trade was not proof that the system didn't work. It was simply part of the probabilities playing out. This perspective requires a level of conviction that most traders never develop. Without belief, every loss feels like an attack on your self-worth. Every setback feels permanent. With belief, losses are neutral, just stepping stones within a long-term strategy. Dennis never ran from losses because his belief system redefined what they meant. They were not verdicts. They were data points. When Dennis decided to prove his argument through the turtle traders, he was making a bold statement to the trading world. By training complete novices, many with no background in finance, he was saying belief in the system and discipline to follow it outweigh any natural gift you think you need. And history proved him right. His students went on to make millions, confirming his conviction that mindset and belief create the trader, not some invisible instinct. In essence, Richard Dennis's story is a reminder that what you believe about trading will shape every action you take. If you believe you cannot do it, you will sabotage yourself before the market ever has a chance. If you believe success is possible through structure and discipline, you will create the conditions for that success to manifest. Your trading destiny is not defined by your background, your education, or your starting capital. It is defined by the beliefs you hold and the consistency with which you act on them. Richard Dennis uncovered that truth and lived it, showing the world that belief is not just a mental accessory, it is the core of every trader's journey. The turtle experiment has become one of the most fascinating stories in trading history because it challenges a myth that still holds many traders back today. The myth that success in the markets is a matter of natural talent. Richard Dennis refused to accept that. He believed that with the right system and the right discipline, almost anyone could be trained to become a profitable trader. The experiment itself was designed as a test, a real-world demonstration that discipline would always outweigh raw talent or instinct when it came to market performance. In the early 1980s, Dennis had already achieved immense success in the futures markets. From a modest background, he built his fortune with an approach that relied heavily on rule-based trading rather than gut feeling. His partner, William Eckhart, took the opposing stance in their debate. Eckhart argued that trading was too complex to be taught, that a person needed innate intuition and psychological wiring to withstand the chaos of the markets. To him, most people would falter under pressure, regardless of how well they were trained. Dennis disagreed, insisting that systematic methods could transform ordinary individuals into skilled traders as long as they had the discipline to follow through. To settle the debate, Dennis placed an advertisement, inviting people from all walks of life to apply for his experiment. The candidates chosen included men and women of different ages, backgrounds, and experiences. Some had little to no knowledge of finance. They were not investment bankers, hedge fund managers, or trading prodigies. They were teachers, engineers, accountants, and everyday individuals who showed curiosity and willingness to learn. Dennis put them through an intensive 2-week training program, teaching them a trend-following system built on simple, mechanical rules. The brilliance of this experiment lies in its simplicity. Dennis provided exact instructions on when to enter a trade, how to manage risk, and when to exit. These rules left no room for personal interpretation or emotional interference. The idea was that success would come not from clever predictions or unique insights, but from the consistent application of proven methods. For the turtle traders, this meant their job was not to think like geniuses, but to follow the process, exactly as Dennis laid it out. This approach revealed something powerful about trading mindset. Discipline became the dividing line between success and failure. The turtles who embraced the rules and resisted the urge to deviate were the ones who flourished. They made significant profits and proved Dennis right. Those who strayed, who thought they could improve upon the system or relied on their own intuition instead of the rules, quickly found themselves in trouble. This highlights one of the greatest truths in trading. The market rewards consistency, not brilliance. The turtle experiment demonstrated how fragile talent alone can be in trading. A talented mind might see patterns and feel instincts, but without discipline, those gifts collapse under the weight of fear and greed. In contrast, even a novice with no financial background, armed with discipline and the right mindset, could outperform so-called natural traders by simply sticking to a structured system. Discipline protected them from the destructive tendencies that plague so many traders: panic selling, chasing trends, doubling down on losses, and abandoning strategies in moments of doubt. The story of the turtles also teaches that trading success is not about being right more often than others. It is about managing losses, letting winners run, and executing rules without hesitation. Dennis emphasized to his students that losing trades were inevitable, but as long as the system was followed, the winners would outweigh the losers in the long run. This perspective required emotional control and patience, qualities rooted in discipline rather than talent. For traders today, the turtle experiment remains a reminder that markets are not a playground for gifted elites, but an arena where ordinary individuals can thrive if they train themselves to think and act with discipline. What mattered most was not predicting the future, but responding to the present in a structured, consistent manner. This is why the turtle strategy has endured as a teaching model long after the experiment ended. It embodies the principle that structure, process, and repetition will always outperform erratic flashes of brilliance. Dennis proved through this bold experiment that discipline is the bedrock of trading. It is not the most charismatic, the most educated, or the most instinctive person who wins. It is the one who can remove ego from the equation, follow rules without deviation, and trust the system even when doubt creeps in. The turtle traders became living proof that discipline could transform ordinary individuals into extraordinary performers in one of the most unforgiving arenas of human psychology, the financial markets. One of the most misunderstood concepts in trading is the role of rules. To the untrained mind, rules look like chains. They appear to limit creativity, to suppress intuition, and to restrict the supposed artistry of trading. Many beginners imagine that freedom in the market means doing whatever feels right in the moment, shifting positions according to hunches or emotions. Yet Richard Dennis proved through his own career and through the turtle experiment that the opposite is true. Rules, far from being shackles, are the very tools that create freedom. They protect a trader from their worst instincts and allow them to operate with clarity and confidence in an environment defined by uncertainty. When Dennis trained the turtle traders, he did not simply hand them vague guidelines or inspirational speeches about staying calm. He gave them a precise set of mechanical rules. These rules dictated exactly when to enter a trade, how much to risk, where to place stops, and when to exit. There was no room for improvisation. The brilliance of this approach was not in its complexity, but in its predictability. It was a framework designed to remove as much emotional interference as possible. What many people would have seen as a rigid cage became, for those who embraced it, a source of empowerment. By surrendering to the rules, the turtles were freed from the paralyzing weight of constant decision-making. In trading, decision fatigue is a silent killer. Every moment in the market presents conflicting signals, rapid movements, and endless uncertainty. A trader who approaches this without rules is forced to make dozens of emotionally charged decisions, each of which can be distorted by fear, greed, or ego. This often results in hesitation at the wrong moments and impulsiveness at the worst times. Dennis understood this problem deeply. His rules provided clarity in chaos. When a system tells you exactly what to do, you no longer waste energy debating whether to act. You execute. This execution, repeated with consistency, creates freedom from the emotional storms that sink most traders. Rules also create freedom because they define risk. Without risk parameters, every trade feels dangerous. Every loss feels catastrophic, and every win tempts overconfidence. By enforcing strict rules on position sizing and stop losses, Dennis made sure the turtles never risked more than a small portion of their capital on a single idea. This gave them freedom to continue trading regardless of short-term setbacks. A trader who risks too much feels enslaved to every tick in the market. A trader who risks responsibly feels calm even when trades fail. Rules created the foundation for that calm, liberating them from the fear of ruin. Critics often say that rigid systems prevent traders from adapting to new conditions. But what Dennis taught shows that adaptability does not come from impulsive guesswork. It comes from having rules that already account for uncertainty. Trend following, for instance, does not require predicting when a trend will start or end. It only requires following the rules for entries and exits as price action develops. This gave the turtles the ability to adapt automatically to shifting markets without overthinking. Their adaptability came from their rules, not in spite of them. The psychological freedom that comes from following rules is another powerful dimension. Many traders live in constant self-doubt, questioning whether they are cut out for the markets, whether their instincts are reliable, or whether they should abandon their strategy after a string of losses. Rules silence that mental noise. Instead of wondering what to do next, a trader simply checks the system and acts. This transfers the burden from the trader's emotions to the rules themselves. When a trade loses, it is not a personal failure. It is just the system executing probabilities. This freedom from self-blame and self-doubt is what allows traders to keep playing the long game, which is where true success lies. The turtles who followed Dennis's rules discovered that freedom is not the absence of boundaries, but the presence of structure that keeps you on track. When you know that every trade is guided by tested rules, you are free to live without the crushing pressure of having to be right every time. You are free to focus on execution, free to let go of outcomes you cannot control, and free to sustain yourself in the market long enough to benefit from its opportunities. This is why Richard Dennis emphasized that trading is not about predicting the future, but about following rules in the present. The rules created the mental and financial space for traders to continue operating regardless of what markets did. Instead of fearing uncertainty, they embraced it, because the rules turned uncertainty into a manageable framework. For Dennis and his students, rules were not restrictive. They were liberating, transforming trading from a chaotic gamble into a disciplined craft that gave them freedom over both their actions and their result. Every trader who enters the market brings emotions with them: fear of losing, greed for more, pride when right, and shame when wrong. These emotions are natural, but in the world of trading, they can be destructive forces. Richard Dennis understood this truth and built the turtle strategy, specifically to neutralize the power of emotions. He knew that even the brightest minds, if left to trade on instinct and feelings, would eventually sabotage themselves. The markets are not designed to reward emotional responses. They punish hesitation, they punish overconfidence, and they punish impulsive decisions. For Dennis, the antidote to these emotional traps was simple: a system, a tested, rule-based system that would save traders from themselves. Fear is one of the first enemies a trader encounters. When prices move sharply against a position, fear takes over. The mind begins to imagine worst-case scenarios, and the natural instinct is to cut the trade too early, or to freeze and do nothing while losses grow. The disciplined system, Dennis taught the turtles, removed this paralysis. Stops were predetermined before the trade began. That meant the decision was already made in a calm, rational state, not in the heat of the moment. The turtle had no choice but to follow the stop-loss rule, accept the loss, and move on. By doing this, they were free from the destructive grip of fear. Greed is just as damaging, if not more so. When a position moves favorably, the temptation to take profits too early is immense. Traders often convince themselves that a small win is safer than letting a big trend develop. This short-term greed undermines long-term profitability. Dennis's system countered this by instructing turtles to let winners run according to predefined exit signals. They did not decide when to take profit based on excitement or nerves. They exited only when the rules said so. This forced them to overcome the urge to snatch at quick rewards and taught them patience. In the long run, this was the difference between average results and extraordinary ones. Emotions also create inconsistency. And inconsistency is fatal in trading. One day, a trader might feel confident and increase risk. The next day, after a loss, that same trader might feel cautious and reduce position sizes. This inconsistency means the trader never truly applies a strategy long enough for probabilities to work in their favor. Dennis eliminated this variability by embedding strict risk management rules. Position sizes were calculated mathematically, not emotionally. The turtles had no authority to increase or decrease risk based on how they felt. This systematic approach leveled out the emotional swings and created consistency, which in turn created reliability in their result. Another way emotions destroy traders is through the illusion of control. Many believe that with enough intuition or cleverness, they can outsmart the market. This leads to overtrading, chasing trends late, and ignoring signals when they don't align with personal feelings. Dennis fought this tendency by teaching that the market is bigger than any individual and cannot be controlled. The only control a trader has is over their own behavior: when to enter, how much to risk, and when to exit. The system provided that control. By obeying the rules, the turtles gave up the illusion of controlling the market and focused on controlling themselves. The psychology behind Dennis's system was as important as the mechanics. He wanted his traders to internalize the idea that feelings were not to be trusted in the market. Emotions might serve us in everyday life, warning us of danger or guiding relationships, but in trading they distort perception. A surge of excitement after a winning streak can blind a trader to risk. A wave of despair after a losing streak can convince a trader to abandon a perfectly good system. By drilling his students to focus on rules instead of emotions, Dennis gave them the ability to survive these psychological swings without altering their approach. The deeper lesson here is that consistency in markets does not come from brilliance. It comes from discipline. A trader who relies on emotions might experience bursts of success, but those bursts will be followed by catastrophic mistakes. A trader who relies on systems, however, builds steady, repeatable results. The turtles learned this lesson firsthand. Many of them came into the experiment with no trading background. Yet they outperformed seasoned professionals because they were bound by rules that shielded them from their own emotions. This contrast highlighted the central truth of Dennis's philosophy: emotions destroy, systems save. Richard Dennis showed that trading is less about predicting the future and more about surviving the present without letting emotions dictate decisions. Markets are unpredictable, but human behavior is even more unstable. The turtle strategy worked because it acknowledged this instability and compensated for it with structure. By removing emotion from the process, Dennis created traders who could navigate chaos with calmness, follow the system with trust, and let probabilities unfold without interference. The legacy of Richard Dennis and the turtle traders is not just a story of financial gain, nor is it merely about the clever mechanics of trend-following systems. The real legacy lies in the mindset it carved into the trading world. The Turtle experiment was more than a 2-week crash course. It became proof that mindset is the defining factor of long-term trading success. What endured after the trades were closed and the millions were made was the psychological framework Dennis instilled in his students. The idea that anyone, regardless of background, could thrive in the markets if they embraced discipline, trusted rules, and approached trading with the mindset of probability rather than prediction. When historians and market participants look back at the Turtle experiment, the immediate fascination often centers on the dramatic results. Ordinary people trained in a matter of days went on to generate extraordinary returns. But the deeper truth is that this transformation was not about technical knowledge. It was about belief and discipline being instilled into a mindset that endured well beyond the program. The system itself was mechanical, but the courage to follow it, the willingness to stick with it through drawdowns, and the ability to silence emotional impulses that was the enduring gift. This mindset continued shaping the careers of many turtle traders long after they left Dennis's supervision. The enduring power of this story lies in its ability to inspire generations of traders who never met Richard Dennis. The Turtle legacy travels not because of the specific entry and exit rules, which have been shared, published, and dissected countless times. It travels because it speaks to a universal truth. Human beings are not naturally equipped to trade. Our instincts push us to cut winners short, to hold losers too long, and to act impulsively in the face of uncertainty. What Dennis created was a demonstration that with structure, training, and discipline, even those instincts can be reshaped. The Turtle mindset endures because it proves that success is teachable, transferable, and repeatable when the right framework is in place. This mindset also altered how traders understood freedom. Before Dennis, many believed that success required constant innovation, endless analysis, and unique insights that others could not replicate. The Turtle legacy flipped this notion on its head. It showed that the real freedom in trading comes not from chasing cleverness, but from surrendering to proven rules. It showed that freedom comes from trusting systems over impulses, from embracing consistency over creativity, and from respecting probabilities over prediction. That lesson has outlived the original experiment, shaping not just individuals but entire schools of thought in trading. The mindset that endures is also one of humility before the market. Dennis taught his students that they would never control what the market does. Their only control was over their actions. This humility protected them from ego, from the belief that they could outsmart the crowd or outthink the system. By instilling humility, Dennis gave them resilience. They could withstand losses without falling apart. They could accept uncertainty without feeling paralyzed. And they could continue trading without being consumed by the need to be right. That humility, baked into the Turtle mindset, has proven to be one of its most enduring strengths. Generations of traders who studied the Turtle story found in it a mirror for their own struggles. They saw themselves in the fear, greed, and inconsistency that plagued traders before rules intervened. They saw hope in the idea that transformation was possible, that discipline could replace chaos, and that anyone could learn the craft. This has made the Turtle legacy less about the specific experiment and more about the psychological revolution it symbolized. Even as markets evolved, technologies advanced, and systems became more complex, the core lesson remained the same. It is not talent, but mindset that determines destiny in trading. What continues to endure is the evidence the Turtles provided. They were not seasoned Wall Street elites, yet many went on to have careers that rivaled or surpassed professionals with years of experience. Their results stood as living proof that belief, discipline, and rule following could generate success that outlasted short-term market cycles. For modern traders, their story is a reminder that systems and mindset, when paired, are timeless. The market may change, but the psychology of human behavior remains consistent, and the Turtle strategy was designed to manage exactly that. The legacy also lives on in the countless adaptations, books, and teachings that emerged from the Turtle story. Each retelling may focus on different details, but at its heart, the lesson is always about mindset. That is why traders today, decades later, still find relevance in the Turtle experiment. They look at Dennis's bold bet against the myth of natural-born traders and see a challenge to their own limiting beliefs. They see an invitation to adopt a mindset that endures, not for a season, not for a single bull run, but for a lifetime of trading, where survival and consistency matter more than any one victory. Richard Dennis may not have imagined that his wager with William Eckhart would ripple through history in the way it did. But the mindset he nurtured became far larger than the experiment itself. The turtles were not just traders, they became symbols of what is possible when rules and discipline override emotions and ego. Their story continues to echo because the trading mindset they embodied, belief in systems, humility before markets, and discipline over emotion, remains as vital today as it was when Dennis first gathered his students in a small classroom and taught them the rules that would change their lives.